This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning John Rubino, well-known author and publisher of the website DollarCollapse.com. Good morning, John, and welcome back to our second session here this week.
Morning, Gord.
John, we're going to do something different that we haven't done before. And I asked you just to bring some of the articles that you've been writing, because I know that you go through a lot of reading and trying to decide what is important. So I know that your articles reflect the kinds of things that you're seeing that have really twigged in your imagination. So I have those up. But John, before I let you just jump into these, I need to make a couple points of mechanics here to ask our listeners to open up the slides to full screen viewing. I know I say this every time, but we have so many new listeners now joining us. And there's an icon in the bottom right-hand corner, whether you're on YouTube or SlideShare, to be able to do this. And therefore, you'll be able to see and read these slides a lot easier. We do often have a lot of graphics, and the graphics themselves have a lot of detail. The other point to make is we have below the screen a place where you can fill in comments, ask questions, or make suggestions on future shows. And John and I really solicit that feedback because we find it really valuable and will help us, and hopefully we'll be able to answer some of those questions in future shows. Having said that, John, I have the first caption of one of your articles you wrote on June the 7th up here on the screen. Central bankers dither today, panic tomorrow.
This is about how the world's central banks are kind of in a bind. And, they're the architects of our problems, so we can't feel too sorry for them. But still, they're in a position today where things are falling apart, and everybody expects the central banks to come out with some kind of a plan to fix things, lower interest rates or quantitative easing or asset purchases of some other kind. And at the same time, just about everybody expects them to, in the process of trying to fix these imbalances, screw up their currencies, cause some kind of an accelerated inflation or a currency crisis or something that destabilizes the financial system. So these guys can't win. Whatever they do or they don't do, they're going to get blamed for the mess that is inevitably coming. And so what we're seeing now is them being unable to make up their minds. Some central bankers want to impose some kind of monetary discipline on their countries and want their central governments to cut spending and bring their budget deficits back into line. And other central banks are just willing to open the floodgates and let fly. And so you get the European Central Bank deciding not to cut rates, and the Bank of England deciding not to cut rates, but China cutting its interest rates, and the Fed coming out and saying it's ready to do what it has to do to keep the economy growing, which is an implication that we'll see some kind of quantitative easing coming soon. And the reason that these guys are kind of working at cross purposes is because they don't know what to do. They're no more on top of things than anybody else is anymore, because this is completely uncharted territory. We've never had this much debt build up in the global financial system at the same time that everybody is armed with an unlimited fiat currency printing press. So we've got these two gigantic, titanic forces out there of global debt collapse and unlimited money printing, and nobody knows where it leads or what they should do at any moment in time. And so they're all just reacting. They're all trying to get through the week or the next election or whatever. And because of that, and because of the fact that we've built up so much debt and there really is no solution to this much debt other than some kind of collapse, what we'll see going forward is a series of crises until we get some kind of coordinated action where all the central banks of the world get together and panic together. They all in coordination, come up with a global quantitative easing plan, which is their last ditch effort to keep the global financial system from imploding. And then we'll get to find out whether an unlimited printing press can trump a gigantic but limited global debt collapse. And, my guess that it is that it can, that, for these guys at the central banks, $10 trillion is just a mouse click. And at some point, we'll see numbers like that flowing out of their press releases and flowing from their computers into bank reserves. And that at some point, the numbers will get big enough. If it's not $10 trillion, it'll be $20 trillion or 30 trillion euros or whatever. It'll be a number that's big enough to reverse the deflationary impact of this debt collapse and send us in the other direction, and which will be a currency crisis at some point out there. And so that's on the horizon. And how it plays out is really still to be determined because we've never been here before. But as I said, I think my guess is that an unlimited printing press is going to win in the end, which means that most of the major currencies are headed for the dustbin of history. That the dollar and the euro and the yen are not going to survive for the next decade in their current forms, and the whole concept of fiat currency is going to be discredited at some point, to be replaced by, hopefully, some kind of sound money where governments don't have control of the printing press and where the value of the currency is tied to gold or some other kind of real asset.
John, my view on this, and I like your example of these two huge powers that are going to compete and what we're going to see going forward. But my view is we're under the mistaken belief that in fact monetary policy is the solution. I would argue right now it's been the cause of the problem. And if you only have one tool and it's a hammer, everything looks like a nail. So what's happening is everybody's looking to the central banks to print more money or to, in fact, do something to solve the problem. I don't believe the problem rests with the central banks. The problem, what caused the problem does as part as a contributor, but it rests with a lot of rechanging of public policies, rechanging of different structures globally that have nothing to do with the central banks. Having said that, I fully agree that what you've got with these competing forces, and to me, I've got this image of what it is we're blowing a bubble, and the bubble's got a rip in it, or a balloon, and it's got a rip in it. So the air's coming out, and the only what you can do is you got to pump it faster so that to offset the air that's coming out. So you're increasing it at such a rate. But what inevitably happens when you do that is the balloon just steadily rips, so that it in fact overpowers and it in fact blows. And what we have, in my mind, is a currency extinction event. And this is right out of von Mises. It's right out of any of you study any of the Austrian techniques of what this all leads to. And we will have a collapse of the fiat, of a fiat-based currency system. Nothing wrong with currency system. But when it's not pegged and it's fiat, it will collapse, and it's only inevitable. Now, what comes out of that, we kind of talked about that the other day on global imbalances, and there's going to be no winners. When anything blows, it's going to cover everybody.
There will be winners, though, Gordon. The guys who own gold.
I stand to be corrected on that. There will be winners on it, and some of those winners will be holders of gold. I do have to say, John, how it's held, where it's held, and what form it's held in is going to dictate that, not just whether I have gold.
Yeah, see, that is a very interesting discussion, because how do you protect your gold and your farmland and your silver and your oil?
And you'd better.
From governments that are panicking. Once things really spin out of control, you'll see capital controls and wealth taxes and all kinds of confiscations.
Yeah, or taxation or fees or something.
Yeah,
it'll be new and different. It won't be like 1932 where we confiscated gold. It may be, but it'll be different, but it will be predatory.
Yeah, it will be. And so not only do you have to pick the right assets to survive a global currency collapse, you have to have them in the right place, in the right form to survive a change in government policy that is going to be really detrimental to people who have assets that are just sitting there visible.
Precisely.
Because farmland historically has held up beautifully in times of financial crisis, but you can't take it with you. You can't go away with it. It's sitting right there. It's highly visible. And what's to stop a panicked government from levying a 15 or 20 or 30% wealth tax on the value of your land? And same thing with gold stored domestically. What's to stop them from saying, like they did in the 1930s, you have to give it back to us. We'll give you treasury bonds instead. And other assets in the U.S., especially that are really visible, are IRAs and 401ks. They're just sitting there. They're these untaxed pools of capital that when it really hits the fan and governments really start to panic, they're going to be eyeing those assets. Actually, they already are.
They already are. Exactly.
But they're going to find a way to force you to convert your gold mining stocks in your 401k or your IRA into treasury bonds.
You'll wake up one morning and find out holding gold that you're now being labeled as a financial terrorist.
Yes. Yeah. And selfish, because you aren't willing to invest in government bonds in order to help us help those who can't.
It's your speculation that's brought on this problem.
Yeah. And so what do you do about that? You've made exactly the right investment choices. Your gold mining stocks or your gold bullion or your silver bullion are through the roof. So you're rich on paper. But what happens? How do you protect that at that point? And so that is a fascinating subject that's worth an entire book right now. How do you deal with capital controls when they come? How do you prepare for them, and how do you make sure that you've got as much of your wealth as possible beyond the reach of whatever government entity comes after it? And there aren't any clear answers for that.
John, a year ago, you and I did a series on currency wars, and we talked about capital controls and being a natural part of this evolution of beggar thy neighbor. And we were just talking about in your recent paper, we got capital controls right here. Beginning to talk about in Europe right now, starting to surface as a solution in the European situation.
Yeah, with the bank runs that are going on
right
now, and to stop people from taking their money out of, say, a Spanish bank and putting it into a German bank.
Well, that's been happening in such a degree, and the only reason with the target process in Europe has in fact allowed this to sustain itself. But wait till it starts to flee Europe. Right now, at least it's staying generally within Europe, even though we're seeing a large flight to the U.S. dollar. But when it starts to leave Europe, they'll have to have capital controls outside of the EU. And I think they're worried about that being next.
Yeah, without a doubt. And at the same time, they've got Switzerland trying to keep money out of the country because so much is flowing in. So you've got reverse capital controls in the remaining handful of countries that have strong currencies. So, and this is just the beginning. It could get a lot more extreme than this as panic really sets in. And because we have new technologies now, we don't know what form these capital controls will take, because we've never had global computer systems before, the internet and the kinds of surveillance that are possible now. And so, this is going to be a modern version of an old phenomenon that's going to take on a very new and sinister face, I think, when the time comes.
Well, the old days, bank runs and everybody lining up outside the bank, we all know is different. Now it's all a click of a mouse. It's a mouse click. Mm-hmm. And you have 5,000 chief investment officers clicking their mouse and billions of dollars moving. But it also means with one foul swoop, all of a sudden every ATM in America no longer dispenses cash.
Yeah.
It can happen in a bat of an eye, literally within a couple keystrokes. And so if you take that and start thinking about the movements of capital, how quickly those can happen, and therefore the problems that would be associated with it. So every investor needs to be very, very careful. What they think is secure is in fact maybe not secure. Government will always come in and guarantee it. But one thing I can guarantee, John, the government will guarantee it. But now it's called guaranteed in exactly what? You're going to give me what for this guarantee, and when do I get it, and how do I get it?
Yeah.
You may be an old man before you get it.
Yeah, and then what you get might be worth a tenth in real terms.
Well, that you can also assure be worth a lot less when you do get it.
And so the speed with which this can happen means you can't wait until it's obvious, because that means it could happen the next morning.
Exactly.
And so you have to prepare now when things are ambiguous.
That is exactly right, John.
You have really limited information, which makes it kind of stressful, because you're operating with such limited information that you don't know whether what you do is the right thing, but you have to try because you don't have time to wait until you have complete information. When you have complete information, your choices will be limited to zero. Just sit there and take it, whatever happens. So, it's a tough time to be an aware investor, because you can make all the right decisions regarding asset classes, but then you have this whole new layer of decisions that you have to make about where and how and when to put your investment plan into place.
You had a second paper, Financial Wealth Evaporating, too. Out.
Yeah.
I think they kind of link together here with what we were just talking about.
Yeah, and that's based on a story that came out a couple of weeks ago. When the stock market had fallen far enough in the U.S. to erase the entire gains for the calendar year so far, and it had wiped out 20-some billion dollars of multiple $1 trillion of the wealth of the richest Americans, because they're the ones who tend to own financial assets. Stocks and bonds are mostly in the hands of the top 10% of the rich people in the U.S. And so they're the ones who make the most money when we're blowing up the bubble, and who tend to lose the most money in the initial stages of the bubble bursting. And since the stock market had gone down dramatically earlier this year, they saw a lot of their assets wiped out. And so I wrote that this is really the beginning of a long process in which financial wealth evaporates in the U.S. and the other developed countries, and that's going to impact the rich guys of the world. The 1% will see a lot of the wealth that they built up over the last few years just disappear, and the impact will be felt primarily in high-end retailers. If you've got a Maserati store or your Saks Fifth Avenue or something like that, you'll see a lot less impulse buying by people with way more money than sense, because somebody who, even if you've got $1 billion, if you lost $500 million in the last year, you're going to feel less rich, and you're not going to go out and buy a yacht or really high-end jewelry or anything necessarily. And so the high-end retailers are probably really good shorts right now. And also, a few years into this process, there are going to be some real bargains out there for the people who invest wisely now. Instead of financial assets, the guys who own real assets right now, who have gold bullion stored in a safe vault somewhere, are going to be able to pick up Lamborghinis and yachts and gorgeous jewelry for a song, because those things are going to be sitting there with no other buyers except the people who owned real assets. So it'll be an interesting process, a changing of the guard of the 1%. The new class of rich people in the next few years. Well, there'll be two. One is the old money who were wise enough to keep most of their assets in real things, and the new generation of rich folks who were wise enough now to buy real assets like gold and silver and hold on to them while they go up dramatically as the currency crisis really gets going.
We're going to see one of the greatest asset transfers in the history of mankind. And it's assets that are being removed from pension plans and things like that and disappearing, but not into the ether, disappearing into other hands. And so, and I'm not talking about the paper assets of pensions, but underlying assets that it'll be translated into. But there's going to be a whole, as you correctly point out, John, a whole new generation of very key players who were preparing for the kind of event that comes out of a currency extinction event.
Yeah. The paper assets will evaporate, and
right.
The real stuff will appreciate, especially in terms of paper assets. So, there will be a new generation of rich folks in the next decade, and a lot of them will be today's gold bugs, which I think will be fascinating to watch, and I can't wait to see it.
You had another article on gold miners that you thought were finally going to start out.
Yeah, the gold mining stocks have just gotten whacked in the last couple of years. They've dramatically underperformed gold and silver, and which means that a lot of people who made kind of the right investment choice, they bought mining shares because they expected gold and silver to go up in value, and for the mining shares to at least keep up or possibly outperform, because that's historically the way it's worked. And it hasn't worked this time around. Gold mining shares and silver mining shares have fallen dramatically, while gold and silver have, held up reasonably well. They've had corrections, but not nearly as severe as the correction in the mining shares. And a big part of the reason for that is that energy prices, especially oil, have gone up faster than gold and silver in the last few years, which means the cost structure of miners has deteriorated. It's getting more and more expensive to get gold and silver out of the ground, and so the margins of the companies that do that have been squeezed, so they don't make nearly as much as they would have otherwise from the gold and silver they're selling. But lately, oil has gone down dramatically, especially in the U.S., and that has, other things being equal, allowed the miners to widen their margins. And so all of a sudden, if oil stays down, it's reasonable to project higher earnings and wider margins for the miners going forward. And the market is anticipating this. So the gold and silver mining shares are starting to outperform gold and silver, and let that trend continue for a while. And you'll see a lot of money that's on the sidelines just pour into this little tiny sector of decent, well-capitalized mining shares. And you'll see them really take off. They will become the dot-coms of the next leg of the gold and silver bull market, assuming oil underperforms gold and silver. If oil stays down, and there are fundamental reasons why it might. The global economy is slow. We're using less energy than we have in the past per unit of GDP. And the U.S. is suddenly finding ways to produce more oil than anybody expected, which is, helping the supply-demand equation out there in the global markets. And so, let that continue. Let oil stay down, gold and silver go up, and you'll see the mining shares just take off.
John, question for you. What things are you looking at and are you following closely and you keep your eye on to really protect your assets and your investments that you would consider the drivers of your financial success right now? I'm not talking about specific investment, but from a macro thing, what are you looking at?
Well, obviously Europe is a crucial catalyst for what comes next. I think if Europe falls apart, as it could, Spain deteriorating dramatically and Italy being pulled along as the next domino to fall, and if Spain starts to fall apart, then you've got a really strong case in Europe for some kind of fiscal union in which Germany basically takes over the rest of the continent, and the European Central Bank floods the system with newly created euros in order to finance the whole process, which is really good for gold and silver. So you could see a deflationary scare as Europe falls apart, and then an inflationary spiral as the European Central Bank steps in, and the Fed has to coordinate with the ECB, so you get a global, that process is what I'm watching now and trying to figure out where we are in that process. And at some point, that's extremely favorable for precious metals. So somewhere along the line in the not too distant future, we got an amazing entry point. We might be there now, and it might take one more deflationary scare, which knocks precious metals down a bit before we get there. And, so that's what I'm watching, trying to decide when is the best time to really load up on gold and silver mining stocks, which is, the vehicle that I would use to play this run. And, I've got a lot already, but, I have enough cash sitting there that I can do one more big incursion into that market. And so I'm trying to decide when the right time for that is. And, it might be now. I'm kind of tempted just to jump on a lot of these really cheap mining shares and just, accept that there might be one more down leg before the big up leg comes, or wait a while. I haven't decided yet, but that's the main driver right now.
When it comes, John, I personally would speculate you'll see gold having $100 days gapping up as it moves very quickly. How I look at that is going to be, and there's two sets of triggers I'm looking for. The minor one is I'm looking for the central banks, not the ECB, but other central banks to start shifting policy. And I've begun to see that in the UK with Mervyn King coming out with what I'll call it the Queen's Litro. For $80 billion, which is long-term money financing that he slipped out here about a week ago. And I was anticipating that. I knew it was coming, so I've seen that, and that's where you're seeing some strengthening in my mind here in gold as commodities appear to be putting in some pretty good technical support level. But the key one is because, and I think our listeners need to understand the ECB is different than the Federal Reserve in that it does not have the mandate to, in fact, print and issue money the same way as the Federal Reserve did in the specifics, even in crisis. And I'm looking for the changing in the role and the mandate of the ECB. I'm not looking that it'll be a major broad-based announcement, but in fact, it'll be the legal cover that allows Draghi to do what he was put in there to do. Make no doubt about it, the ECB will print vast amounts of money and increasing their balance sheet. But they can't do it. It's just not the Litro gimmick, which is a repo. It'll be where they can actually legally monetize. And that's the shift. And we're getting close because they've restacked the board of directors. Germany now only has 3 seats. It used to have 8. So it can't even stop it anymore. And you'll have to watch the press very, very closely to see when that shifts. But when it does, you'll know it because gold will be, like I say, gapping $100 a day.
Yeah. They will not let the law get in the way of liquefying the system when the time comes because, they'll be under some serious.
When the crisis happens, the law will be thrown out. But when I say they throw it out, they will pass very quickly late at night at 11 o'clock the authority for the ECB to do it.
Yeah. And they have it ready. It's all written. All they have to do is, they just have to press send on a document.
Precisely. The crisis will allow you to get that signal. And we're very close to it because I don't think Spain is stoppable anymore. I believe the banks have been insolvent for quite some time. We've got another 25% down on housing and real estate in Spain that's coming. The Ponzi bond game that's being done in Spain or in Italy can't sustain itself. So it's only a matter. And I think it's a very short window that we have right now in here. Yeah. And maybe people, John, shouldn't speculate on that on gold. It's like the old expression of making money is not about timing. It's buy right and sit tight. The hardest part is not buying right. The hardest part is sitting tight.
Oh yeah, absolutely. And when you've got some free cash and you're trying to decide what to do with it, you still, even if timing is a bad strategy, it's still an impulse. You still want to get in at a time that's closest to ideal that you can get. And so that's what I think a lot of people are wrestling with now because we've seen gold and silver mining shares especially get whacked, and we've seen gold and silver correct. And so this might be just the perfect time to jump in. But on the other hand, they could drop another 20 or 30% very easily in just the normal course of a bull market. And so I'm dithering.
Well, remember that the central banks want and are scheming late at night. They want to drive gold and silver and commodities down another leg.
Yeah.
Because that gives them the cover and the bang for their buck for the printing that's about to come. And if inflation is too high, they won't get the same bang for their buck. So they'd like nothing more than another 10 to 15% push down, put more fear, and therefore it'll take a longer period of time to gain that momentum back. Put the fear of God in everybody, and they're less tempted once your fingers have been burnt.
On the other hand, like you said, when it happens, it's going to happen fast.
You won't get in.
We'll see $100 days up in gold, $10 days up in silver, and if you're not there and you miss that day, you'll feel like an idiot. Yeah.
You'll sit there and say, well, I need a bit of a pullback because it's just jumped, and you'll sit there and it'll pull back just a little bit, and boom, it'll go again, and you'll never get in. And you'll watch it. You'll be standing there just watching it. It's a classic. And the only way to answer that is you wait until it's pretty clear that you have a crisis, then you dollar cost average in. That's usually what any kind of long-term investor will tell you that's got scars all over their back.
Now that is absolutely right. Because timing a market is impossible because there are things going on that you can't see ahead of time. And it's happening during the night when your market is closed a lot of the time. So the best solution for something like this, which is a long-term bull market, is to buy a little bit each week or each month. And when the big turn comes, you will at least be partially invested and maybe almost fully invested. And you'll be happy you did it that way.
Do you really care if it's next month, 2 months, or 2 years if you're looking at a long-term strategy? You just need to know that it's going to.
Yeah.
And I don't mean to be that trite on it, but sometimes we can lock ourselves into trying to make those extra few points. I've always found the hardest things are the last 5% and the bottom 5%. And if I just stop chasing those and just go for the bigger 20%, it's a lot easier. But John, we're past our hard line. We need to break here for this session. Another one. Great discussion. Any last comments you'd like to make, or things that are on your mind right now with what you plan on writing? And also how people could learn more about dollarcollapse.com.
Yeah, well, I think the capital controls idea is something that everybody should be paying attention to now, because clearly governments are going to be limiting the movement of capital in the very near future and possibly trying to confiscate what they've trapped within their borders. And so we need to be thinking about that and planning for it. And it's not clear yet how we do that, but it's something that everybody especially with gold and silver, but also with big balances in IRAs and 401ks, should be thinking about and educating themselves about and beginning to plan for. I'll be putting something about this up at dollarcollapse.com pretty soon, with the idea of starting the discussion and maybe coming up with some strategies for protecting wealth in an era of confiscations and capital controls.
Which is clearly coming. John, I really encourage you. I think the feedback I get is that a lot of listeners, that's what they're looking for right now. They sense in their gut it's going to be predatory, confiscatory, and taxation-wise, but they just don't know what to do.
Yeah.
And at least some general, anybody has the time to really think it through to help them, because most of our listeners are so busy just trying to make a go of it with shrinking disposable incomes right now. They don't have time to do the research.
Agreed.
Got a break. Looking forward to having you back next month as we continue these discussions. And so until then, all the best.
Great. Thanks, Gordon.
Talk to you later.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.